So there's a lot of benefits when investing in a real estate syndication. You have the cash flow, you have depreciation. The one that I feel is often overlooked is the tax benefits that come into play. And this is how 90% of millionaires have built their wealth through real estate, utilizing this specific feature that can help get them there. So when we think of depreciation, like if you've acquired a single family property, there's something called straight line depreciation. It means your home will appreciate on it based off a lifespan of 27 and a half years. In commercial real estate, we can conduct something called a cost segregation study, when an engineer will go to the property or properties and then hypothetically tear down the property by asset type. So personal property, let's say like cabinetry, has a lifespan of 5 to 7 years. Land improvements has a lifespan of 15 years. Why is that important? When you are speeding up the lifespan of a specific asset within that property, you are capturing more of that depreciation faster. Why that's important is the average hold period in a lot of investments is somewhere between 3 to 5 years. So you want to capture more of that up front so you can pass those losses off to investors and limited partners like yourself. So what happens is when you get that K1, and again, the K1 is a document that you get from the IRS that shows your investment in a partnership. There's 2 lines in there that are very important. One line is capital contributed. It's basically talking about what your principal investment is. The line beneath that is current year net income, and then in parentheses, loss. That line there, what you want to see is what the loss is going to be, because when a cost segregation study is conducted, there's usually somewhere between 30 to 60% of depreciation captured that year. So if you invested $100,000, you could expect $30,000 to $60,000 in a paper loss, not an actual loss, but a paper loss. And what you can do is take that paper loss and offset it against some of your passive gains, maybe that you've had from the stock market, as an example, on a brokerage account, to reduce your taxable income. And let's say your losses are more than your gains. The losses carry over in perpetuity. There is no lifespan. It's not like a use it or lose it for a given period of time, okay? And then if you qualify as a real estate professional, you can take those passive losses and you can offset against your active income. That is the holy grail. You want to have a conversation of how you can become a real estate professional, happy to do that. But that's another massive piece to do that. And this is how you can bring down and reduce your taxable income, is through this type of investing. I hope you found this helpful.